Most people think a family office is just a fancy term for a very large bank account, something reserved for the ultra wealthy. But that's not really what it is. In my 30 years across private equity and global boards, I've seen the same pattern play out again and again. Wealth is created through incredible professional stamina, but very often it's lost through amateur management. I'm Jean-Baptiste Wautier. Whether you're just starting your investing journey or you have reached the point where your assets require more formal structure, the core principles of investing remain the same. Today, I want to go back to basics. We will look at a few investing 101 fundamentals and also talk about how investors gradually move from managing a portfolio to building something closer to a family office. The most successful family office investors start with why before they think about how. Before you choose a single stock or a fund, start with a few simple questions. First, what's your time horizon? Are you investing for something short term, or are you building wealth that should last decades? That decision changes everything. Let's look at a simple example. Imagine two investors who buy the exact same asset. 1 year later, the market drops 25%. At that point, their reactions are very different. The first investor panics and sells. For them, that volatility becomes a permanent loss. The second investor sees the same drop but understands the long-term strategy. They hold the position, and 5 years later, the investment has doubled. Same market movement, but with very different outcomes. And that's where many beginners get confused because they confuse volatility with risk. Volatility is simply the price you pay for performance. Market move up and down. Risk is the permanent loss of capital. Institutional investors understand that distinction very clearly. They accept volatility, but they work extremely hard to avoid and understand real risk. And over time, that difference in mindset separates professional investors from everyone else. So understanding risk is the foundation of investing. But building real wealth comes from the discipline of how you invest. If you want to invest like a family office, it doesn't have to be complicated. Most successful family offices follow 4 simple disciplines. Number 1, conviction over volume. Retail investors are often told to buy the index and own everything. Family offices tend to do the opposite. Instead of hundreds of positions and portfolio approach, they focus on a small number of investments they truly understand, often 10 to 15, and follow them closely. Number 2, respect the friction. In private equity, we learn quickly that the biggest drag on returns, apart from time, isn't about quarter, it's friction. Taxes, fees, transaction costs quietly eat into performance, which is why professional investors focus on their after-tax, after-fee returns. Number 3, let compounding work. Compounding is powerful, but it requires patience. Too many investors react to short-term market noise and interrupt the process. Professional stamina is the ability to do nothing, when doing nothing is the hardest thing to do. Time and time again, I saw it firsthand during my 20 years at BC Partners, for example, when you often would need to wait for many, many years before a structural and significant uptick in value would happen, and this after years of hard work and strategic inflections. Lastly, liquidity is opportunity. Professional investors keep liquidity, what we often call dry powder, not just for safety, but for opportunity. When markets panic and others are forced to sell, liquidity gives you the flexibility to act. So when does a personal portfolio evolve into something closer to a family office? For most investors, the shift happens when complexity begins to outgrow capacity. Taxes, legal structure, multiple asset classes make investing harder to manage casually. Many families reach this point somewhere between $50 million and $100 million as assets, although the mindset often starts earlier. At that stage, investors begin moving from passive participants in other people's funds to more direct stewards of capital. Family offices also introduce governance, often through an investment committee or a charter that defines how decisions are made. I personally lived through that transition in my own investing journey, as I hadn't planned at all when to create a family office or even plan for the long term. A couple of years ago, discussing with one of my private bankers, she made me realize I needed structure, purpose, governance, if I wanted to create a lasting legacy with principles and impact that would outlive me. Successful long-term investing isn't about chasing the latest opportunity or having perfect timing. It's about building the right structure, maintaining discipline, and staying patient when markets become uncomfortable. Whether you're managing your first $10,000 or your first $100 million, the goal is the same. Over time, the shift is from being a consumer of capital to becoming a steward of it. If you're interested in learning more about investing, private equity, or how family offices operate, I'll continue sharing lessons and insights from my own experience. And if you have questions about getting started that I didn't answer here, feel free to drop them in the comments. Thanks for watching and see you next time.